All right, welcome back to the Closer Room AZ. I'm your host, Jesse Moreno. I'm a realtor and investor here in the greater city of Phoenix, Arizona. And before we introduce our guest, quick shout out again to our sponsor of the day, Drake's Title Agency here in Phoenix. They have multiple locations. They're also in Nevada. So if you guys are looking for a great service, great customer service from start to finish on your title or your escrow, reach out to them. Simple fact that I thought I found pretty interesting and want you guys to know is that Drake's Title has closed over 200,000 transactions since August of 2024. So speaks volumes about this company. So reach out to them. They're easy to be reached to. Their contact number is 602-589-5300, or you could always email them at drigstitle.com.
Yeah.
Or their website. So reach out to them, and they'll take care of all your needs. Anyhow, again, thank you for joining us. And today we have our special guest. She's a return. We are starting part 2 of our conversation that we left off earlier today. Elba Gill with Nations Lending. Welcome back, Elba.
Thank you. Thank you so much for having me here today.
Yeah, you know, we spent some good time, I was going to say yesterday, but actually earlier today in our conversation,
Yes.
we spent some good time speaking about FHA, and the time went by way too quick. Right?
Yes.
I was
we
like-
try not to, but it did.
It did. And we were like, look, we're going to talk about conventional and talk about FHA, maybe a little bit about jumbo loans or VA. And we never got out of FHA.
I know. Such a good product that we didn't get out.
So if you guys didn't get a chance to listen to that podcast, make sure that you do, because there's some great info in that podcast regarding FHA and how to get into it with no money down, a little bit of money down, or some assistance from some of her programs that you offer. So you listen to that podcast, because you're going to miss out if you don't get into it. All right. So we want to jump right into today in this conversation, conventional financing, right? So kind of lead us a little bit into down payments available in conventional financing. And before you do, let me just let the listeners know that when we were talking about FHA earlier, we said, look, 3.5% is the minimal, or the minimum you could put down. You could put up to 20%. Or 50%, but you're going to be stuck with something called PMI, private mortgage insurance, right?
Correct.
Okay. Which conventional financing doesn't have after certain down payment, I believe. So tell us a little bit about what down payments we could put down in a conventional financing.
Cool. Okay. The minimum is going to be 3%.
Okay.
We have 3%, 5%. You can do 10%. You can do any percent after the 3. But if we want to avoid the mortgage insurance, it's going to be 20% or more. So that's definitely one of the things I always prepare my clients to do if they're able to, so that way we can avoid that extra payment a month. Mm-hmm.
Great. And so we know that after 20%, you're going to avoid the PMI, private mortgage insurance, right? So what are some of the guidelines to remove it? How do we get rid of it?
So number 1, it will be to do the 20% down payment when you purchase the property. It's going to be 20% of the purchase price of the property. Number 2 will be to do a refinance on the property. Let's say, for example, you bought it years ago, and it was an FHA, or even if it wasn't conventional, and then the property value went up, or sometimes you put a lot of money into your principal, and you have 20% of the equity of the home already free of the loan. We can also do a refinance and delete the primary mortgage insurance for you.
Okay, cool. Does some of your lenders, and I don't know if this works for you guys or not, but just some of the lenders that you work with, if they refinance, is there a cost for them to do that?
Yes, so it depends. We can get rid of the mortgage insurance with the refinance. So we can take the mortgage insurance out, and we can also do an adjustment to the rate if the rate's better for you guys or for the client. And we can also do a recap, which we order an appraisal, and we order an appraisal, like kind of the appraisal that when you bought the property, and we want to make sure that the equity is there, so we can remove the mortgage insurance. So there's a couple of ways, and it's cheaper to do the recap, so that way you can only pay for the appraisal, usually less than $700. You pay for the appraisal, and then we can remove if the equity is there on the home. For the refinance, it's going to be, I want to say, around $2,000, the fees for the title and everything. And we use Drake's Title. I do all my refinances with Drake's Title.
All right.
So definitely, they're cheaper option for us. Yeah.
All right, good. So it's important that the listeners reach out to Elba.
Yes.
When they are looking to remove that PMI off their credit.
Yeah.
Or off their mortgage. Either way, reach out to her for anything. I mean, any mortgage needs, obviously we want you to reach out to you to help, you can help them out. All right. How about through conventional financing, we got fixed rates. Can we do adjustable rates?
So with the conventional, no,
Okay.
I don't do adjustables. I do buy downs.
Buy downs.
So we do buy downs, yes.
Okay.
So if we have money from the seller or the client wants to put more money when they purchase their home, we can do buy downs for the 1 or 2 years. So
Okay.
for the conventional, FHA is 3 years and conventional is 2 years, up to 2 years.
Okay. So just like FHA, we could do the 2-1, 3-1 buy downs to get there.
Yes.
So same. So we got the same options.
Yeah.
I know you mentioned on our last podcast that FHA had probably better pricing when it comes to the interest rates, but either way, you can still do that type of buy downs through conventional financing, right?
Yes, correct.
What about credit scores? We know you mentioned 500 on an FHA. You've seen them, or I think you had a deal, right? You told me maybe 513.
513, yeah, FHA.
You helped out a buyer.
Yeah.
Was it a buyer refinance or was it?
It was a buyer. Yeah,
Buyer.
it was a buyer with 7% down payment. Yeah.
Okay. When it comes to conventional, then what's the minimal credit score?
620.
620.
So it would be a 620. So
All right.
definitely the 620 is the minimum. Now, every time that I assess my clients or I talk to my clients, definitely a 620 will be a higher interest rate for a conventional because usually conventional are for more stable FICO score or credit score. So definitely 620 is the regulation, but we can do it. I mean, a lot of people say, well, it's going to be my rate's going to be higher if I go with the conventional. Yes, but you're not going to have a mortgage insurance if we put more down payment. So it's kind of different on the options, but that's the minimum, 620.
And would you say that it's also the same then, whether you're a first-time buyer or already a seasonal buyer? Doesn't really matter. You either go FHA or conventional. They're going to both be beneficial depending on that person's needs.
It will be more beneficial to go FHA as far as when it's your first time home buying.
Okay.
Unless your FICO score, your credit score is very strong, then we'll definitely go to a conventional.
Okay.
Yeah, for a first time home buying.
All right. And I don't know if I asked you on the last conversation in our last podcast, but what about when it comes to income? Is there an income qualifications for either or program? So like on conventional, is it just W-2s and maybe self-employed 1099s?
No, it's both. It's both W-2s for conventional and and FHA, and then also self-employed for both of them.
Okay.
Yeah, we use both of them.
Is there any type of creative financing for either or? Like if you said, hey, FHA, they're a little more lenient because they also accept just bank statements, for example, or maybe conventional just does bank statements.
I want to say for FHA, it's more lenient as far as the debts. So if you have a lot of debts for first-time home buyers or not first-time home buyers, as far as debts, it has a little bit more wiggle room to go higher on your purchase price. So definitely people that have a lot of debts, we can look into an FHA better than rather than a conventional.
Let's talk a little bit about debt. I don't know. I want to learn something here. So what about when you talk a little bit about debt, let's say student loans?
Yes.
Which way would be better? Which financing program would be better when somebody has a lot of student loans where maybe the guidelines are a little bit more lenient if they go FHA or conventional? What would you say?
So right now the regulation for both of them are going to be the same. It's 0.5. So definitely before it was a 1% and a 0.5. So we will go with the conventional. Now we can use a 0.5% of whatever the balance is on your student loans, unless you have a payment plan, which a lot of people don't have payment plans right now. But definitely if your student loan doesn't have a payment amount on your credit report, we have to take 0.5 of that balance as far as your payment. So that affects you as far as your ratios of debts.
Okay, gotcha. All right. Ooh, all right.
Yes, well, so a lot of people that have a lot.
So you know what, Mr. Listeners, if you're listening to this, please make sure you don't get yourself in too much debt because either way, they're going to try to qualify you based on your debt, right?
Yeah.
I've heard people say, well, I got student loan. I don't think they're going to count them against me when I try to buy a property or refinance. And they will. Yeah. They're going to take 0.5% of that balance and whatever that payment, whatever that dollar amount is, they're going to qualify you on that.
A lot of people don't do any of the payment arrangements with the schools or with the whatever, if it's private or not. And I always say it's better to do a payment arrangement or an income-based arrangement because usually will be lower than me taking 0.5% of the whole balance. So a lot of people are like, oh, well, I have a forbearance or I don't have to pay it until next year. But if you have a payment amount already on your FICO score and your credit report, then that's what we have to take. And usually it will be lower if you call and do your payment arrangement, depending on your income.
Okay.
Yeah.
Cool. It sounds like to me conventional has a little. It's not not too complicated. A little bit less restrictions, perhaps. It's kind of cut and dry.
Yeah.
To get into this type of financing, whether it's a purchase or refinancing. When you go conventional, and FHA has a little bit more. From our last conversation, a little more features and benefits.
Yeah.
But really, it depends on you, the buyer, or you, like the client, looking to refinance, and where you're at with that need, right? So it's important to always reach out to your professional advisor here. In this case, your senior loan officer, in this case, Alva Gill, to take care of that. So it's important that you guys reach out. Let's talk a little bit about, anything on convention that I'm probably missing.
Yes, with the buy downs and
You
the closing
said yes,
costs.
like I'm missing a lot here. All
with
right.
the conventional, I want to make sure that last conversation we had with FHA, it was 6% seller concessions that we can ask the seller to pay.
Yes.
But with this one, it will be only 3%. So
right.
we will have a little bit, half of the money to use for buying down, with rates, for closing costs, anything like that. So that's very important. A lot of people say, well,
8%.
what if, it's going to be 3%. It's going to be, we can increase it if the down payment is higher. So it just depends on the down payment, but the minimum will be the 3%.
Gotcha.
Yeah. So definitely that's one of the things that, and a lot of people ask me, well, why do people get conventional? Sometimes properties do qualify more for a conventional or FHA, depending on the conventional, and you have more experience with that. But that's one of the things that I always tell my clients. Some properties won't qualify for an FHA. So that's one of the reasons why people will get a conventional loan. So.
Right. That's another topic we could get into later on, because I don't want to go into underwriting guideline topics. Now, you're a loan officer, but I know you also have, as loan officers and as realtors, believe it or not, I want to tell you that we're kind of like underwriters. We know what they're looking for and what they're going to be asking for. So we're very careful when submitting our transactions to make it work, to get our buyers or our clients are refinancing into that program. But there is a lot of things to consider when we're doing things, because underwriters will be looking at the appraisals, and we look at certain things to make sure if they fit this bucket in order to get this refinanced or purchase done. And I'm throwing two different things here because I want people to know it's not just on the refinancing part of it, but it's also on the purchase side of it. When people are buying a house, you go FHA, there's certain things that the house needs to make sure that in order for it to qualify, the home can't have certain issues with the property. And the same way with conventional. So, but that's a whole different thing, and I have a lot of questions on that one. But we could tackle that on another one, so we don't get sidetracked. Because I want them to know about conventional, and I want them to know about FHAs, which we learned on our prior podcast. Let's talk a little bit about jumbo loans.
Okay.
Well, no. I want to talk about VAs.
Okay.
VAs. I was going to hit VAs, and then when you hit me with the, I've got some more stuff, I said, oh, man, okay.
That's okay.
Anything else? Maybe there's anything else that I'm missing on conventional?
No, conventional, I think it's a lot, but I think for now, that's it.
Okay, I told you we're going to make this fun. So it's one of those like, Jesse, you hit me up, and if I don't know it, you're going to put me on the spot. Let's do that.
Yeah.
I'm good with it. All right, VA loans.
So veteran administration loans, and usually they're called VA because of veterans. A little bit of information about them. There's 0% down payment. Most of them can avoid the mortgage insurance depending on their ranking and depending on the way they serve the military. So a lot of people are confused with saying, oh, VA is going to be everything free, everything this. No, well, there's cost to it as well. There's a mortgage insurance that has to be paid up front, or it can be added to the loan, or it can be waived depending on the veteran's settlement.
All right. And you're right. There's, as far as VAs, no mortgage insurance, no PMI.
Correct.
Right. But zero down payment, but sometimes there is some cost to it. So need to them to be aware of that. There is some what they qualify for based on their entitlements for their VA deals.
The funding fee.
The funding fee. So, but VAs, it's another great program for our veterans, and only our veterans can use it.
Yes, only veterans. Yes.
Right. All right. Now, if you have a VA loan, can they? And they haven't, they already used part of their VA. Can they buy another property if they have some additional entitlement available?
Yeah, they can. Definitely can.
All right, awesome. All right, and I think you had mentioned to me. I know you don't do a lot of jumbo loans, or you've done them, but what's the benefit between a jumbo loan? Well, let's talk about the limits. Maybe if you have the numbers for me, or at least an idea for my listeners to know. when does a loan become a jumbo loan? After a certain dollar amount, after a certain amount, right?
So
What
usually
that be?
it's over 806 and 500, I believe, this year. Yeah, 806 500. So if it's over 806 $500 loan amount, it's gonna have to be a jumbo loan with jumbo regulations, with jumbo rates, with jumbo guidelines and everything.
Okay.
Yeah.
Rates a little bit different from.
Yes, they're a little bit higher. Yeah.
Are they
usually,
higher?
Yeah. And the
Okay.
FICO score is usually 700 plus the minimum.
Interesting.
So
okay.
it will be different from the conventional. Yeah. Mhm.
Okay. So you got to have better credit score.
Yes, because it's a lot of money that the bank is lending you. So
Okay. What about down payment? Same deal.
yeah.
Can
so
they still put down 3%, 3.5%?
no, usually it won't be the 3%, but we can go 5, 10, 15. So it depends on the FICO score and depends on the situation that we have on as far as debt to income ratios and the debts and everything. Yeah.
So the lender's going to require a little more skin.
Yes,
on the
because it's a
buyer's-
higher loan
on the
amount.
client
Yeah.
side. Okay. Interesting.
Yeah.
That makes sense. Okay. Let's talk about this one. I know I asked earlier about DSCR
Yes.
loans, right? Can you tell me what that stands for?
Yes. Well, let me see. Let me see if I remember correctly.
Debt service
Yeah.
coverage ratio,
Ratio,
right?
there you go.
All right. Yeah, didn't want to put you on the spot.
Yeah,
I'm sorry.
no, that's fine. You're fine. I
You know
am
what?
not good
All
with
these-
acronyms.
All these acronyms that are out there. You know, I had a
I
buddy
know.
of mine call me probably about a couple days back, and I'm sure he's going to probably end up watching this podcast, or you know, he supports me, and so we watches them, and he might come back and he asked me, hey Jesse, you know, I'm trying to do some DSCRs.
DSCRs.
Yeah, debt service coverage ratio loans. And I asked him, well, what is that? Talk to me about it. I've heard of it. I haven't really done them because, in my opinion, they're better for probably investor type transactions more so than anybody else. And since I'm an investor, he asked me, what's your experience? Have you been utilizing them and how it works? And a little bit of my experience on how it works, I just kind of share with you as we were talking, as I know they're utilizing the income of that property to qualify the buyers the buyers into this property, right? So depending on what that property looks like, what their triple net income may be from that particular property, it's what they're utilizing it, right? So it's asset-based qualification. So you mentioned you kind of do some of that stuff too, right?
Yes.
Can you maybe share a little bit about that particular product?
Yes, and that product we actually do it in house and outside of the house.
Okay.
I'm actually doing right now the one that I'm doing right now. It's a refinance because you can do a purchase and a refinance DSCR. So a lot of people that have this specific client that I have right now, it has a paid off property and they want to pull some cash out. So that's why I'm doing the DSCR for a cash out refinance. So a lot of people think just DSCR purchase. No, it can also be a refinance.
It can be.
Yes,
Interesting.
it can be a refinance, and it can be cash out, or it can be rate term. It can be whatever.
Now,
a lot of people
does
do
it have to be an investment property for that?
Yes, a lot of people do it when they want to get out of a hard money lending company. So that's most of the times that they want to get out of the hard money interest rate because it's really high. So the rates are pretty good. Honestly, the DSCR rates that we have, they're very good. They're very decent. So. One of the major thing is it has to be an investment property. You cannot live in the property. It has to be an investment property.
Now,
So
does it have to be a 2-unit or more, or can it be a single family?
it can be a single family.
Okay,
Yeah,
it
correct.
can be.
Usually it's 20% down payment for the DSCR. And as far as, like you mentioned, as far as the appraisal, it has to have an appraisal, and the appraiser will give us a rental analysis. That rental analysis, whatever amount of the rental analysis is, say, for example, the appraiser said that it can be rented for $3,000, then the payment has to be $3,000 or less. That's pretty much what we look for. The major thing is that one, and will be the assets. You have to have a 6-month reserve. So
6
if your
months,
payment it's $1,000, then you have to have $6,000 reserves for as far as your savings or checking account. Yeah.
Okay. Wow. Interesting to know.
Yep.
Well, see, I'm learning something today, and I want to pick your brain a little more on that off this podcast, because we are again running in our time. We want to keep this engaging for our listeners, obviously. So we're going to jump into this, not that particular conversation, but we're going to jump into some other things here shortly, and that's going to be our part 3 of our podcast. So I'm going to invite everybody back to our podcast here shortly. Come back, listen to us, listen to Alba's expertise on the mortgage side, and just get educated on some great knowledge of what's going on with the mortgage side of the business.
Yeah.
And perhaps we want to talk about what's going on in the market here shortly as well. So till then, thank you so much for joining us here at the Mortgage. On the Mortgage Room is my investment site, but here at the Closing Room, AZ, thank you for joining us. And until then, until our next conversation, wishing everybody a fantastic day and set no limits.
Thank you.